Ladies and gentlemen, if you own silver, stop what you're doing and listen closely. What I'm about to tell you is happening faster than anyone anticipated, and if you're not paying attention, you're about to be blindsided. The world of finance isn't slowing down, it's accelerating, and the manipulation of precious metals is reaching a level that could shock the markets. This is not a drill. This is reality, and it's unfolding right in front of your eyes. Ladies and gentlemen, the reality we face today is not something that can be ignored or delayed. Financial systems are moving at a pace that is far beyond what most people are prepared to comprehend. The signs are all around us, yet very few are paying attention. The average investor, the average citizen, is lulled into a false sense of security by news headlines and the comforting narrative that everything is fine, but the truth is it isn't. Every day, policies are being enacted, decisions are being made behind closed doors, and market forces are being manipulated in ways that few can see and even fewer understand. The consequences of ignoring these trends are not hypothetical, they are immediate and tangible. What is happening is accelerating faster than most analysts or financial commentators are willing to admit. We are living in a time when central banks have more power than ever before, and they are using it aggressively to prop up systems that are fundamentally unstable. Money is being created at a pace that defies logic, and debt is reaching levels that are completely unsustainable. The very foundation of global finance rests on the assumption that this can continue indefinitely, but history has shown us time and time again that such assumptions are dangerous. The moment when the illusion cracks is coming, and it is coming sooner than anyone expects or suppose. To wait passively to assume that the current stability will last is to gamble with your wealth, your security, and your future. At the same time, the signals in the market are becoming more pronounced. Supply chains, global trade, currency values, interest rates, every facet of the economy is signaling stress, and yet the broader public remains largely oblivious. This is the perfect storm for a sudden, dramatic shift. When the disconnect between reality and perception grows too wide, the correction is swift and unforgiving. People who are not paying attention, who have not prepared, will find themselves exposed. Those who are aware, who understand the dynamics at play, can protect themselves and in some cases even thrive in the chaos. What makes this moment particularly urgent is the speed at which change is occurring. Not long ago, economic adjustments unfolded over months or years. Now they happen in days, sometimes hours. Policy decisions, market reactions, and geopolitical events interact in a complex web that moves with extraordinary rapidity. The window to act wisely is shrinking, and hesitation carries enormous risk. Those who delay until they feel sure will likely find that the opportunity has passed, leaving them to deal with consequences that could have been mitigated. Timing has never been more critical, and awareness has never been more essential. Consider the forces that are at work: governments printing money, inflation quietly eroding purchasing power, market interventions masking real value. These are not abstract problems. They affect the cost of living, retirement savings, and the ability to preserve wealth. Ignoring these factors is equivalent to walking blindfolded toward a cliff. The further the world moves along this trajectory, the steeper the fall becomes for those who are unprepared. This is not fear-mongering, it is the sober assessment of risk based on observable trends and historical patterns. Even for those who consider themselves financially savvy, the pace of change can be shocking. The mechanisms that maintain the illusion of stability are incredibly sophisticated, and few understand how deeply these forces penetrate the system. Manipulation occurs on multiple levels, and most observers only see the surface. By the time the effects are visible to the general public, the adjustment has already begun, and options for mitigating loss are limited. Acting before the correction is obvious is not just prudent, it is essential. This is why awareness and decisive action are so critical. It is not enough to hope that markets will stabilize or that policymakers will get it right. Waiting for confirmation from conventional sources is a mistake. By the time the mainstream acknowledges the problem, the opportunity to protect oneself will be gone. The difference between security and vulnerability lies in foresight and understanding the trajectory of these forces before they become headline news. The moment we are in demands a clear-eyed recognition of reality. Complacency is the enemy. Every day that passes without understanding the true nature of the forces at work increases risk. Those who grasp the urgency of the moment, who recognize the rapid acceleration of economic instability, have a chance to safeguard their positions and make rational decisions. Those who ignore it, or worse, dismiss it as alarmism, may find that the consequences are both swift and severe. History is replete with examples of individuals and societies that ignored warning signs only to be unprepared when the inevitable adjustment occurred. The path forward is simple in concept but challenging in practice. Observe the indicators, understand the dynamics, and act with the clarity that comes from knowledge rather than emotion. Every decision made today carries amplified consequences because the pace of change is faster than it has ever been. To underestimate this is to underestimate the reality of the world we live in, a world where speed, leverage, and intervention combine to accelerate events beyond conventional expectation. There is no time to waste, no luxury of waiting, and no substitute for vigilance. The moment is now. Awareness, preparation, and decisive action are the only means of navigating what is unfolding. Those who recognize the urgency and respond accordingly will stand a far better chance of preserving wealth and maintaining stability in their lives. Those who fail to recognize it will likely face challenges they could have avoided. This is the stark reality of our time, and it is unfolding faster than most people are prepared to comprehend. When you take a closer look at the world around us, it becomes clear that very little in the financial system is what it appears to be. Prices, valuations, and market movements are not determined by the forces of supply and demand in the way most people think. Instead, they are manipulated, propped up, and engineered by institutions with enormous power, institutions that are not accountable to the individual investor. This is not some conspiracy theory. It is the reality of modern finance. Policies, interventions, and artificial supports distort the market at nearly every level, creating an illusion of stability that is dangerously deceptive. For decades, governments and central banks have convinced people that the economy can be controlled, that inflation can be tamed, and that markets can be smoothed indefinitely, and yet every action they take creates consequences that are delayed, hidden, and amplified. When you print money, when you prop up failing institutions, when you manipulate interest rates, you are not creating genuine instability. You are merely postponing the reckoning. The problem is that most investors do not see the underlying dynamics. They only see the superficial results. Rising stock prices, a seemingly stable currency, or the comfort of a financial news headline that tells them everything is fine. The truth is, the reality behind the numbers is far more concerning. Market manipulation today is more sophisticated than ever before. It is not just about buying or selling assets. It is about creating perceptions, influencing expectations, and engineering confidence. Institutions with near limitless resources can push markets in directions that make little sense to ordinary investors. When they want a market to appear strong, they can make it strong. When they want it to appear weak, they can make it weak. And the general public, relying on traditional signals and conventional wisdom, remains oblivious. By the time the manipulation becomes apparent, the consequences have already been set in motion. One of the most dangerous aspects of this manipulation is how it interacts with the broader economy. Artificially low interest rates, for example, encourage borrowing and debt accumulation far beyond sustainable levels. Artificially propped up asset prices give the illusion of wealth, encouraging spending and investment in areas that are unsustainable. And yet, when the manipulation ends, when reality asserts itself, The fallout is severe and swift. What looked like prosperity can vanish almost overnight, leaving individuals and institutions alike exposed. The disconnect between perception and reality grows with each intervention, making the eventual correction more painful. Consider also the role of global coordination. This is not limited to one country or one market. Financial institutions around the world are connected in ways that most people do not realize. When one institution on moves, others follow. When one government prints money, other governments feel pressure to do the same. This creates a chain reaction in which manipulations in one part of the system have amplified effects elsewhere. The appearance of stability is reinforced, but the fragility of the system grows. The more interventions occur, the more the markets depend on them, and the less able they are to function naturally. The longer this continues, the more devastating the eventual adjustment will be. Meanwhile, the average investor is misled by these engineered signals. They are told to trust the market, to trust the experts, to trust that everything is under control. They are encouraged to buy the assets that appear strong and sell the assets that appear weak, even though those appearances are often the result of manipulation. In reality, the people benefiting from this system are the institutions doing the manipulating. Ordinary investors are left chasing illusions, often buying at the top and selling at the bottom. They are rewarded with short-term comfort and punished with long-term consequences. What makes this particularly alarming is how quickly the consequences can unfold. Years of manipulation can be undone in weeks or even days when confidence falters or external shocks hit. The system is built on faith, and when faith is shaken, the markets react violently. Those who recognize this risk in advance have the opportunity to act. Those who don't are caught by surprise. Understanding the reality of manipulation is not just an intellectual exercise, it's a survival skill. It is the difference between maintaining wealth and seeing it evaporate when the system shifts. This is why awareness is critical to navigate the current landscape successfully. One must see past the headlines, the charts, and the official narratives. One must understand the mechanism behind market movements, the incentives driving institutions, and the distortions created by intervention. Only by grasping these realities can an individual make informed decisions and protect themselves from the fallout that inevitably comes when artificial stability can no longer be maintained. At the end of the day, what we are witnessing is a struggle between perception and reality. The markets are being guided, nudged, and sometimes forced into shapes that suit the agendas of powerful institutions. Ordinary investors are left to interpret these signals as genuine indicators, unaware that they are participating in a carefully constructed illusion. The sooner one recognizes this, the sooner one can act strategically rather than react emotionally. The urgency is not hypothetical. It is present, immediate, and accelerating. The lesson is clear: do not trust appearances, do not rely on the comfort of manipulated markets, and do not assume that stability is natural. Understand the forces at play, recognize the artificial nature of so much of what is presented as normal, and prepare accordingly. Those who do will stand a far better chance of navigating the storm, while those who ignore the reality will face consequences that could have been avoided. The financial world is not what it seems, and time is not on the side of the unprepared. In times like these, when the financial system is stretched to its limits and markets are propped up by artificial interventions, tangible assets are the only true safeguard against the erosion of wealth. The reality is that paper promises, stocks, bonds, even government-backed currencies are vulnerable in ways that few people fully understand. When trust in the system wavers, these instruments can lose value almost overnight, leaving individuals exposed. It is in this environment that certain assets demonstrate their unique capacity to preserve wealth, each to act as a hedge against uncertainty, and to maintain purchasing power when everything else falters. These assets are not hypothetical. They have proven their worth repeatedly throughout history. During periods of hyperinflation, banking crisis, and currency collapses, They have been the one consistent form of protection. Unlike paper-based instruments, they cannot be created at will by central banks, nor can their supply be inflated to meaningless levels overnight. They carry intrinsic value independent of government policy, market manipulation, or accounting tricks. For anyone concerned with preserving their purchasing power and avoiding the risks associated with a collapsing financial system, these assets are indispensable. What makes them particularly effective as a hedge is their resilience in the face of instability. When fiat currencies decline, the cost of living rises, or financial institutions falter, these assets maintain value because they are tangible, universally recognized, and difficult to manipulate on a large scale. They are not subject to the whims of interest rate changes or debt issuance. They are not promises on paper, but actual physical stores of value. For someone trying to navigate a world of accelerating monetary debasement and economic distortion, this is not a minor consideration. It is a fundamental lifeline. Moreover, their scarcity amplifies their protective qualities. Unlike currencies that can be printed endlessly, their availability is limited. Demand often exceeds supply, particularly during periods of uncertainty. This creates a natural floor to their value, one that is not dependent on central bank policies or market sentiment. In contrast, the value of stocks, bonds, and even other commodities can be manipulated, leveraged, and distorted, often creating bubbles that inevitably collapse. Tangible assets, by virtue of their inherent scarcity, are far less susceptible to such distortions. It is also worth noting that these assets are not just defensive instruments, they are strategic tools. They provide flexibility and optionality in times of crisis. If markets crash, currencies lose value, or inflation accelerates, they are liquid stores of wealth that can be relied upon when nothing else can. In essence, they are insurance, a means of transferring risk away from systems that are increasingly fragile and towards something that is fundamentally stable. Those who ignore this risk or assume that government intervention will always save them are making a dangerous bet, one that history has shown repeatedly to be misguided. This is why timing is crucial. When uncertainty is building and manipulation is rampant, acquiring such assets before the wider market reacts can make a significant difference. Those who wait for confirmation from conventional sources or for media coverage are often too late. By the time mainstream attention arrives, prices may have already shifted dramatically, reducing the effectiveness of the hedge and limiting the opportunity for preservation of wealth. Recognizing the value of these assets before the broader public does is a form of foresight that can make a critical difference in turbulent times. Another key consideration is that these assets are highly portable and universally recognized. They can be exchanged almost anywhere, unlike certain investments that are tied to particular institutions, countries, or legal frameworks. This mobility provides an additional layer of security in an era of global uncertainty where governments may impose restrictions, currencies may lose value, and financial institutions may fail. The ability to hold wealth in a form that is universally accepted becomes not just advantageous but essential. History offers countless examples of why tangible assets serve as a hedge. During periods of currency collapse, when paper money became worthless, these assets retained purchasing power. When banks failed, when markets imploded, they provided stability and security. These lessons are not theoretical, they are empirically proven, and yet most investors continue to ignore them, lulled into complacency by the illusion of stability created by central banks and financial authorities. The irony is that those who are most confident in the system are often the most exposed when reality asserts itself. The lesson here is simple yet profound. Wealth preservation requires more than faith in government, banks, or conventional markets. It requires an understanding of the dynamics at play, an appreciation for scarcity and intrinsic value, and a willingness to act proactively. The most effective hedge is not something that fluctuates with the whims of policy or market sentiment. It is something that stands independent, immune to manipulation, and capable of maintaining its value when the rest of the system falters. In practical terms, the significance of this cannot be overstated. The financial world is increasingly unpredictable. Inflationary pressures, mounting debt, political instability, and systemic manipulation are converging in ways that amplify risk. Ordinary paper-based investments may offer short-term gains or appear stable on the surface, but their value is contingent on confidence in a system that is inherently fragile. The tangible, finite, universally recognized asset acts as a safeguard, a measure of security that cannot be replicated by promises or digital accounting entries. Ultimately, the choice is clear. Those who recognize the fragility of the financial system and act to protect themselves are far better positioned to withstand shocks, preserve purchasing power, and navigate uncertainty. Those who rely solely on paper-based instruments or trust in the perpetuation of artificial stability are leaving themselves exposed to risks that are escalating rapidly. Understanding the role of this asset as a hedge, as a safe store of value, and as a tool for preservation is not optional, it is essential. And the window to act is closing faster than many realize. Now is the time to recognize that passivity is no longer an option. The world is moving faster than most people realize, and the longer you wait, the narrower your options become. You cannot rely on institutions, governments, or conventional authorities to protect your wealth or ensure your financial security. They are entangled in the same flawed system, constrained by policies that create more risk even as they pretend to mitigate it. Every day the clock is ticking, and every day the system becomes more unstable. To ignore what is happening is to place yourself in a position of vulnerability that will inevitably be exploited by forces beyond your control. The first step is awareness, understanding the realities of the financial world, the manipulation, the distortions, the fragility is essential. Most people operate under the assumption that markets are rational, that prices reflect true value, and that policymakers are acting in the public interest. This is a dangerous misconception. Markets today are engineered. They are influenced by unseen hands and subject to forces that are invisible to the casual observer. The apparent stability is an illusion, and waiting until the truth becomes obvious will leave you reacting to events rather than controlling your own destiny. Awareness is not optional, discernal. It is the foundation upon which any sound strategy must be built. Once you recognize the risks, action becomes necessary. It is not enough to simply know that something is happening. You must position yourself accordingly. Delaying decisions or hoping that conditions will normalize is a luxury that time no longer affords. The window to act wisely is closing. Those who fail to adjust their positions, diversify appropriately, or protect themselves against the vulnerabilities in the system are setting themselves up for consequences that could have been avoided. Decisive action is the only way to convert awareness into security. This is not about speculation, it is about prudence. When a system is distorted by intervention, manipulated by central authorities, and stretched beyond sustainable limits, the prudent move is to shift toward what is tangible, resilient, and beyond the reach of policy manipulation. It is to recognize that wealth is not a number on a screen or a balance in an account. It is the purchasing power you can rely on when the system falters. Those who act early, who prioritize preservation over short-term gain, will be in a far stronger position when reality asserts itself. Education is another critical component. Understanding why the system is unstable, how it has been manipulated, and what forces are driving risk allows you to make informed decisions rather than reactive ones. The average investor is often at a disadvantage because they rely on conventional narratives and mainstream advice. They do not see the structural weaknesses until it is too late. By arming yourself with knowledge, by questioning assumptions and conventional wisdom, you create the ability to act strategically. Knowledge is not just power, it is protection, a way to safeguard yourself against the inevitable shocks that the broader public will experience unprepared. Moreover, this is a moment that requires vigilance. Situations are evolving at a pace that can surprise even seasoned observers. New policies, market interventions, and economic shocks can accelerate instability within days or weeks. Waiting. G for confirmation from authorities or the media is a fatal mistake. By the time mainstream sources acknowledge the reality, the opportunity to protect yourself may have passed. Awareness alone is insufficient. You must combine it with timeliness, decisiveness, and the courage to act when others hesitate. The stakes are too high for inaction. Consider also the broader implications. Financial instability does not exist in isolation. It affects employment, prices, savings, and access to essential goods. The consequences are far-reaching, touching every aspect of life. Those who prepare thoughtfully are not just protecting wealth, they are preserving their freedom, their choices, and their ability to respond to crisis. Those who ignore the warning signs may find themselves constrained, vulnerable, and forced to react under duress rather than with strategy. The lesson is simple. Preparation is not optional in a system this fragile. Finally, the choice comes down to responsibility. You cannot rely on luck, hope, or the assurances of others to secure your financial future. The responsibility lies with you, and the time to act is now. Hesitation, delay, or complacency will only magnify risk. By recognizing the realities, understanding the mechanisms at play, and taking decisive action, you place yourself in a position of relative safety and control. The window to act is narrowing, and the consequences of inaction are increasingly severe. This is why awareness must be paired with decisive steps. You cannot merely observe. You must engage, evaluate, and adjust. You must understand the fragility of the system, the limits of government intervention, and the potential for sudden shifts in markets and purchasing power. And then you must make concrete decisions that align with that understanding. Every day that passes without action is a day in which risk accumulates in opportunity. Why diminishes? The longer you wait, the fewer options remain and the greater the potential for loss. Ultimately, the lesson is clear. Knowledge without action is insufficient. Awareness must lead to preparation, and preparation must lead to decisive implementation. Those who recognize the fragility of the system and act proactively will be far better positioned to protect themselves, preserve wealth, and navigate the uncertainty ahead. Those who do not will find that the consequences of inaction are not delayed, they are immediate, tangible, and potentially devastating. This is not a theoretical discussion. It is a call to recognize reality, to take responsibility, and to act before it is too late. The time to move is now, and the cost of hesitation is growing by the day. So I say this with urgency and conviction. Don't scroll past this moment. Don't assume someone else will protect your wealth for you. If you own silver, now is the time to pay attention, to think critically, and to understand the forces shaping your financial future. History has shown us that when manipulation collapses and reality sets in, it's too late to react. Act wisely, act now, and protect yourself before the system forces your hand. The future is moving faster than expected, and silver may be your only shield.